Howdy, friends. Steve DePoe here with the Rose Realty team with this week's Real Estate Vlog for North Texas. Before we get started, we ask you to go to YouTube and subscribe to our YouTube channel, Let's Do Real Estate Texas. There's no charge, but you will be alerted to updates and changes to our series Spotlight on Community, Focus on Small Business, and of course, our weekly real estate updates on North Texas. Thank you. Let's get started. This week, 4.5 tax deductions that you can claim when you own your home. But before we get started, I want to point out this blue logo down here. The Rose Realty team has been identified as one of the top 500 agents or teams in the Metroplex. Now you might be thinking, 500, that's not that great. Think about it. There are over 20,000 real estate agents in the Metroplex. So if you're part of the top 500, that means you're in the top 2% of all real estate agents in the Metroplex. That's outstanding. So we appreciate the honor. Our team worked hard the last couple of years, and we look for bigger and better things as we move forward. But this week, 4.5 tax deductions that you can make when you own your home. Okay, so number one, let's understand something. We're not accountants, okay? We're not accountants or financial attorneys or anything like that. Any of these things any of these things we're saying here, you should kind of grab onto, talk to your accountant, and make sure you do things the right way. Okay. So first, selling costs. So the cost of selling your home, if you were going to sell your home today, the cost of selling your home is tax deductible. So escrow costs, title insurance costs, advertising costs, escrow fees, I think I said, legal fees, real estate commissions, all those kinds of things. They're tax deductible. So when you close, your escrow officer or the title company is going to give you a rundown of everything that you spent. Usually what that means is you're going to need a check for this much, at closing, or you're going to get, if you're selling, it's going to be, here's how much you're going to get at the end of the process, and it'll list it, it'll itemize these things there, and you can take those things and you can submit them, in April 15th for costs from the previous year. Okay, so selling costs. Now, home improvements and repairs. Now, this comes into two categories here. So number one, if you need to make home improvements or repairs to sell your house, so your agent comes in and says, hey, it would be a good idea to take down that wallpaper and paint this a neutral color, that kind of stuff. If you have to fix your roof or put in a new water heater or whatever, those kinds, if it's done within 90 days of the sale, then those things are tax deductible, and you can deduct them from your taxes, again, April 15th. You also, if you do home improvements to the house, what that also does over the years, what that also does is raises the baseline of your house. So if you buy it for $300,000, you put in $50,000, and you sell it for $400,000, your capital gains is in 100, your capital gains is only 50. Okay, but again, talk to your accountant about stuff like that. Property taxes. So up to you are able to deduct up to $10,000 in property taxes on your taxes every year. Now you might remember, I'm thinking it was probably 3, maybe 4 years ago. The federal government and their tax code changed that from whatever you were paying in taxes to a $10,000, limit. Now, here in North Texas, we're kind of bumping up against, or just above that $10,000 threshold. You got to think in places like New York, New Jersey, and in California, their property taxes far exceed that, and so they're not able to deduct the whole, all of their property taxes, every year. Mortgage interest, of course, mortgage interest. So you're going to pay interest on your loan, on your mortgage, and you get to deduct that mortgage interest on your taxes. Capital gains for sellers. Now, so I kind of just mentioned this a kind of a second ago. So if you're single and you sell your house for $200,000 above what you originally purchased the house at. I say $200,000 because you notice over here it says $250,000 limit for single people. Then none of that $200,000 is taxable. If you sell it for $300,000 as an example over what you originally bought it at, then only $50,000 is taxable. So that's great. So in today's market where the valuations are just climbing higher and higher, if you were to sell your house today, you would have that capital gains deduction there. And then it's $250,000 for a single and $500,000 for a married couple. So you're able to deduct that sort of off the top of whatever your equity is and whatever you gained in the equity in your house. So I hope that was helpful. Again, advice is that you take this information, talk to your accountant, your accountant or your financial advisor about it, and make sure you do the right things, on your taxes. Next week, we're going to talk about a program that Keller Williams has, that the Rose Realty team just used 3 times already this year with our clients, called iFinder. It's something that you've heard about on commercials, mostly on the radio, but on commercials, we've kind of heard about it with other companies, and we're going to help explain the difference between those companies and the iFinder program with Keller Williams and Go Management and the Rose Realty team. This is Steve DePoe with the Rose Realty team. I'm going to bounce.